I just saw the data for the first few weeks of July, and the end of the day, for the first couple weeks of July, the consumers in the aggregate spent across debit cards, credit cards, checks written, Zelle, money out of the cash out of the ATMs, cash it from tellers, all the different ways they spent it. They spent about 9% plus more than they spent in the first 2 weeks of July of 21. The transaction volume grew at 6 or 7%, 6% plus. That means people are doing more things. And so the consumer spending is strong. The second thing is the customers have in their accounts more money mid-month of July than they did in June. And so they continue to build their account balances, especially in the lower wage earning populations we have in our customer base. So we serve all these customers. So to give you a sense, the customer that pre-pandemic would have had 1 to 2,000 of average balances in their accounts had an average of 14, now has 7,000 plus in that account. That same customer 2.5 years later. The customer had between 2 and 5, averaged 3,500. Come forward 2.5 years later, they have 13,000. So there's money in accounts. And by the way, they're not going down. They went up a little around tax refunds. They came down when they spent some tax refunds, and that was April, May. And then you saw them start to grow in June, and you're seeing it continue in July. So they have money in accounts. The third thing is, are they borrowing? And the answer is, we're seeing some growth in our credit cards, some growth in our home equity balances, stabilization on mortgage balances. But at the end of the day, they have plenty of capacity in home equity to borrow. They were $30 billion pre-pandemic. The loans are now in the low 20s, so there's that capacity. Credit cards were $95 billion pre-pandemic. They're now mid-80s, moving up. There's that capacity, plus there's other lines. So there's capacity to borrow. The home values are still strong, so that's good. So as you look across all that data, you say the consumer's strong. Now, when you do a survey of what consumers feel like, they say consumer sentiment's down, and that's because they read about inflation, they hear about inflation. So the answer is what they're saying they see versus what they're doing is kind of interesting. And then you look at the unemployment levels and wage growth, and it's strong. So that's the conundrum. That's the Fed's toughest challenge. They have a strong consumer, and they need to slow down the economy, and that's a lot of work. And so we see everything constructive on the consumer side in our database. And by the way, the wealthy customers, the same thing, except for frankly, they had to pay more taxes in the second quarter, 50% more by estimates than last year. So therefore, their balances went down, and now they're recovering.
So, Brian, I think you just put your finger on one of the questions, certainly that's perplexing to me, that a lot of the data indicate the consumer is really strong, but the consumer sentiment is really, really weak. How can it be that good when we feel that bad about it? And I guess the follow-on question to that is, can we talk ourselves into a downturn? How much of this is sentiment and how much of this is behavior?
Well, a couple of things. So, my experience with consumers across the years, especially around the investment side, which I ran for the company before I was CEO for a bunch of years. You could see the stock market trading volume of retail customers correlate with sentiment. So when people don't feel good, they don't put as much money in the equity market, and you're seeing it kick back in a little bit now. But that went down a lot, and so there's these things do play off each other. So the sentiment out there plays off of stock market levels, house price belief, whether the debate about whether I'm going to have a job, all those things play off. But the actual behavior plays off of really one straightforward thing: do I have a job, and am I getting paid? And if I have a job and I'm getting paid, I pay my bills. I can provide for my family. I can take my vacations. I can buy the new car, and all those things. And that right now, unemployment in the mid threes is a very low unemployment rate. And so that's why the consumers, are spending, even though they may not feel good, because they're being told, worry about a European war, worry about an energy crisis, worry about a food crisis. And by the way, there's inflation, and really worry about that. And inflation, there's been many quotes about inflation that people have dragged out, but it's insidious, and it gets on people's minds, and it causes a behavior change. It just hasn't changed it yet. And that's the key point. It hasn't changed it yet. And if they get it right, it ought to start feeling better, and then maybe it won't have to change it as much.
As you say, employment is probably the single biggest indicator of where we're headed in the economy overall. Employment is extremely strong right now. But does that suggest that if, in fact, we're to have a recession, which many people, including Bank of America, project, that we have to get a lot more unemployment pretty quickly?
Well, that's kind of the interesting thing. If you look at the blue chip economist, and you look at our economist, and you look at the street economists, a subset of blue chip economists, I was just kind of looking through it. And so the 10 or 11 large investment banks have economists. I think we and one other one have a a negative part in 22 or 23. The rest of you have very slow growth. So you went from a 5% growth rate to maybe a 2% growth rate or even less, down to really no growth. So you're seeing this thing slow down. The interesting thing is all of them still have unemployment. If you take the blue chip and look at it, the highest is like 5%, which doesn't seem consistent with a recession of a level people are predicting. Because remember, we were 5% unemployment moving down to 17 and things like that. So it's a little hard to figure out how people can predict the economy slowing that much and employment staying as strong as it, because the averages are in the low fours, and that's something I think either people adjust one side or the other side. If you listen to the Fed chair, he'll talk about they need to have labor market that's not so tight, and it's very tight now, 2 job openings for every job. But that is kind of the conundrum that when I look down all those stats, I sort of say, wait a second, how can you have that kind of slow economic growth, but that kind of strong employment in the absolute sense coexist? And the answer is one's got to give, and we'll see.
One more data point, Brian, if I may. You also have access into a lot of American business, and not just the really big ones, but small and medium-sized enterprises as well, right across the country. What are they mainly worried about as you talk to them?
Well, number one, the activity in our small business, 5 million under revenue companies, that core small business, we're one of the largest, if not the largest player in it by far. As I said earlier, the origination activity, new loans originated, was up about 10% year over year, to 2.9 billion versus 2.6, 2.7. So that's good. That means they're still demanding credit. Okay. And then we looked at the small business, again, 5 million under revenue companies, their use of their small business credit cards, that's growing in double digits plus. That means they're using these are the business cards, using it to buy things and do things. So that's strong. What they were worried about in our surveys that we do for inflation, for them, that's input, costs going up, wage, getting people and how much they have to pay them, can't even find them if I want to pay them, and then can I fill the orders I have? And so if you talk to the manufacturing people, are saying my problem is the supply chains still are bumping around, and I've got stuff that I've got orders out out through at year end next year, no problem at all. I just got to get the stuff in and I need all the component parts to complete the thing and then sell it. I've got 60%, 70%, 80%, and I need to get the labor to do it. And that it's a very difficult time to manage that sort of mechanism. But the good news is they've got committed contracts to take the stuff when it's done. And so the supply chain has pushed out the demand cycle a little bit because there's just a lot of stuff that still has to be manufactured and sold, in various industries, and that 50 million and under revenue company, they all worry about all the things you read about in the paper because they read the same papers and think about them, and I actually see them in day-to-day execution, supply chain tightness, labor tightness, input prices. But on the other hand, what they also see is good demand for their products and services, which gives them optimism.